when all of the policy news started to bubble up, when it became very clear that the market wasn't accurately pricing in the significant downside to tariffs. I told all of our clients, especially in wealth, hey, look, we should not be adding to risk at this point. And honestly, that was a super uncomfortable message for me to deliver. I think you've known me for a long time, Tom, and you know that I like to add to risk and I love equities. But it's been really difficult to have any visibility into the future course of prices and into earnings. So our message hasn't changed. Do not add to risk at this moment.
What do you do with Mag 7? What do you do with the Plays of America? Well, they either have it in their portfolio at Citi Wealth Management, or they got a sidecar you don't know about where they own 6,000 shares of Apple. What do you do with big tech?
Look, in general, I would say the quality of the big tech companies, their balance sheets, their cash generation are outstanding. But we also know we have to pay very close attention to technicals, sentiment, and positioning in moments like this. And it's no surprise to anyone who's listening that these companies were significant overweights, not just for US-based investors, but for global investors. So I think what we've seen in terms of the technical pressure and taking that risk down over the last number of months has made sense with the greater uncertainty. I still think this core part of high quality tech growth will perform well over the medium term. But I think the pressure is going to be indiscriminate right now, Tom. I don't expect that these companies are going to be able to meaningfully outperform while the policy growth and earnings uncertainty remains this high.
So, Kate, we saw even before the tariff news of this week that international markets were significantly outperforming the U.S. markets, the most we've seen in a very, very long time here. Yeah. Does that persist, do you think? Are you seeing clients moving money outside of the U.S.?
I think the thing that we've observed the most has been a rotation reducing of the U.S. overweight rather than a super constructive view that all of these regions outside of the U.S. Will have better fundamentals and better macro. So again, I'm going to go back to the sentiment, positioning, and technicals and say this was a rebalancing of a significant overweight to the U.S. To some of these other regions, and frankly led to some of this outperformance. But I think it would be I think we need to be careful about saying that, say, European equities or Japanese equities in particular can outperform in an environment where the U.S. is leading the global growth story lower.
Kate, I want to talk about the loss of confidence. This is something you've been so good at over the years. And we've got all sorts of people. David Blanchflower saying, listen to the non-experts. When Citigroup looks at the soft data, what do you see?
Well, we see a softening across all segments in the soft data, Tom. I think that's important. It's not just the official strategists and economists all over the street within Citi and elsewhere who have been taking down their forecasts or highlighting risks, but consumer surveys, corporate surveys across industries, private and public companies, we're getting the same message. The expectation is that inflation is going to remain sticky, in some cases get worse, and the expectation is that the visibility into their all of the inputs to making decisions is very, very low right now. So I would expect that this soft data will translate into hard data over coming months unless there is some real confidence restoring action. Candidly, I can't think of what that will be. I think we've taken this hit. We're going to have to reprice lower on the back of it. But these surveys, whether it's UMich or the Richmond Fed CFO survey, these are things we have to watch very closely.